In this lesson, I'm going to talk about the confusion over flip zones, aka swap zones. I will also explain when it's safe to use this concept and how to utilize Q points for maximum efficiency. But I would like to clarify that I don't use flip zones myself. In fact, in some of the previous lessons that were made back in 2016, I explicitly said that I don't want to have anything to do with flip zones. But because people kept asking and asking and asking, eventually I decided to address the issue. Now, for me, if a supply or a demand zone has been broken, I will typically turn to market profile for the remainder of the trading day to look for lower time frame opportunities. And I absolutely 100% discourage the use of flip zones on low time frames especially, which means anything below the daily chart. Okay, flip zones. I've been very reluctant to even mention flip zones because if I'm being completely honest with you guys, it's one of those supply-demand concepts that someone somewhere mixed up with support resistance. So flip zones, they come from that old idea of support resistance where once a key level has been broken, the next time price visits the same area, somehow it will magically turn into an opposing key level. But that's actually a bit wrong. On occasion, you may come across something that initially looks like a flip zone, but as you will see in the following slides, there will always be a brand new area of supply or demand. And one thing that comes to mind that this was like a mishmash of quasi-supply demand traders who stumbled across a few rules of supply and demand and then decided that it is okay to cut through candles to justify the use of so-called flip zones. But let's remember one of the basic rules of supply and demand. Never cut through candles. This was in lesson 1. This was in all of the intros, everything. So we do not cut through candles ever. If a demand has been broken, you cannot then decide to cut through the old level from the other side as soon as the price comes back to it. Now, for those of you who have not heard about flip zones, here's the idea. So you have this blue strong demand, you can see here. And as you can see, the price kind of came back to test it and created some consolidation and then finally a bounce. Now, the idea behind flip zones is that once the zone gets taken out, I've marked it here with this big red X, then the next time the price comes back to this broken level from the underside, it will then act as a resistance. Now, if I zoom out and show you these orangey circles here, it does indeed look as if the demand that was broken is now a supply, like it's turned into a supply. However, when you have inexperienced eyes that don't really focus enough on the details, all sorts of things can look like magic. So let's analyze the situation of flip zones. Okay, so here's a supply zone that got created after the break of the demand. So instead of this magical flip zone that everyone seems to be talking about, in most cases, you will see that there's a brand new supply created in its place, shown here in green. And this was formed after the demand gets broken. And in fact, if I'm going to nitpick, the newly created supply didn't really even touch that old area, but instead created a new supply somewhere else, slightly lower. So there's no mythical levels here, there's only facts. So demand did not turn into supply through some like voodoo practices, but plain and simple, it created a new area that was then tradable once the price pulled back to it sometime later. Therefore, one rule, if you're considering trading the flip zones, if a brand new supply and demand area is created after the old level has been broken, the new area, aka flip zone, can be traded just like any other new supply-demand zone. If you're expecting to trade the so-called flip zone without the existence of a newly formed opposing area, then you're going to be getting a lot of these kind of moments where the price kind of simply cuts through and just whips around this, non-existent support turned resistance, because there's nothing there. So there's nothing to support it. So here is a little flow diagram to help you with visualizing this process. You need to see that your supply-demand zone that you've been referencing and you've been looking at has been taken out. It's been broken. Again, I don't advocate the use of flip zones, but if you do see that there is a newly created zone that is forming, you can then use the process to validate the new zone according to the supply and demand rules. And then when the price comes back to test it, that is how you would approach your trade. You would then either use a scoring table to ensure that the new area is tradable, or you can trade it through a confirmation through price action rejection. Now, one great thing about using Q points for any newly formed swings that qualify for the trigger of Q points is that you can determine which one of these newly formed zones will be more likely to be reactive. You can also exclude the zones that are not in these established swing extremes, and this is how you would do it in a very systematic and repeatable way. You're always using the same process to get to your trading decision. What do I mean by this? Let's have a look at this example. So here I have this blue demand that was tested twice. So here's the first test, here's the second test. And both of these tests gave you a pretty decent bounce. Now when the price comes back to test this area for the third time, the zone gets taken out. The candle that ultimately broke the demand area created this little speed bump supply. And if you then analyze this chart further, you can see that the price came back to test it for the first time. However, there was only a minimal reaction, and ultimately it didn't cause another strong move in the same direction. So when you're scoring these flip zones and you're determining whether you can trade them or not, seeing a speed bump supply that doesn't have another clear low and a clear high is definitely a situation where you don't really want to get involved. And the reason is it's a lack of clearly established swing high and a swing low means that this is not really an established new swing, but rather a continuation of whatever was happening before that. For the creation of Q points to trigger, so that you have that confirmed established swing, you need a clear low, you need a clear high, and you also need that 50% retracement that ultimately triggers the Q points. And this is something that came up as we were mentoring more and more people through the courses in the program, and usually coming from people who have not been dealing with charts that long, they got a little bit confused. So instead of using an established high and a low that are pretty obvious, for example, in this chart, there would be this high and this low, and they used to pick these interesting highs that are not, like, for me, they're not really the high of the move. So I kept trying to understand why they would even think that that would qualify as a high. And for example, on this chart, I would say that there's only a couple of areas that you may consider to be potentially a new swing. So one is a very obvious one. This is your high. This would be your low. And then when the price retraces, obviously it would be a creation of Q points somewhere up here. But I actually had a few people that picked this high. And they're like, well, I calculated my Q points based on this high. So I was like, but that's not an obvious high. Why would you pick that? Now, as traders, obviously, you want to start visualizing whether the high and the low are going to be the new reference swing. It's a scenario that I actually play in my head quite a lot. So when an area gets broken, even before the move starts to go towards that 50% retracement, I will imagine where my Q point might be based on the available data. And sometimes you can have these localized cue points. So obviously you will have large cue points, then daily cue points, 4-hour cue points, 1-hour cue points. So it's entirely possible that whilst you have this move A to B, so your reference high and a low, that you also have another smaller one when it's happening. For example, this would be another A to B move, and then another localized cue point here, but not on the same time frame. You would be, dropping down to a different time frame. However, we had a few people who were taking some really suspect moves that are more a continuation of a trend more than anything else. And these were mainly traders who only had about like 6 or 7 months of screen time. So they're fairly new to trading. It's one of the reasons why I put down the minimum requirement of having 1 to 2 years of screen time. So what am I talking about? Well, I'm talking about, like, for example, let's have a look at these moves here. It's very choppy. And this is what a trader was saying to me. We were actually working on this chart. And he goes, well, this is a high and that's a low. So therefore, on a smaller time frame, I'm going to use that move as my reference cue point. And therefore, I'm going to go in. It's a bit of a slippery slope, that. And I'll tell you why. You also need to ensure that the move that came before the A to B move also has at least 25 to 30% squiggle before it. Otherwise, it's not really a swing, it's more a trend continuation. Now for another refresh of how cue points work. So here's the original established swing at the time when this demand area was being all bouncy and responsive. And here is the price arriving at that demand area for the third time right before it's going to go straight through it. So at this point, you are bouncing between the established swing created based on this high and this low. Now I had to zoom out a little to show you what's happening. So this is the demand that I was showing you in the previous slide. So just to show you. So that was the demand. So zooming out, the demand does get broken. But up until then, it was pretty reactive. So obviously a localized swing at that point was this reference low and this reference high. And why is this an established low and a high? Because what came before it is actually around 25 to 30% of a squiggle when you look back from whatever low and high you're referencing. And this happens a lot on lower time frames that tend to be a lot more choppy. So even though, like, this is a 1 hour chart, you won't really see this happening that much on the daily because the daily charts have a lot more trading information. So therefore, it's a little bit harder to create these kind of moves. So anytime someone sends us a support question of cue points repainting, just please switch to a higher time frame. It's always the same issue. So with this squiggle being here before the swing actually happened, this entire A to B move gets validated for a cue point. And sure enough, it was very bouncy, very reactive. But after the third test, it finally breaks. So the reference high and a low that we were using before for the other cue point is now obliterated. It doesn't exist anymore. With the price falling further, the cue points will then look back once again and then jump to the next available reference A and B swing. So they jumped to a bigger swing. It's not a repaint. It's simply the only established swing reference that you have going forward. If you now combine this piece of information with the fact that some people will try to trade flip zones like these, which are really more speed bumps than anything else, and expecting this trade to last forever and ever because you're expecting this downtrend to just continue endlessly. It's just not how things are in the markets today. On the other hand, you may sometimes get the following scenario. Now here's a demand, nice and reactive. And then quite a bit of time later, again, going to zoom out to show you this. So here is your reactive demand from the previous slide. This is where it gets broken. After this demand breaks, so the price creates another low. And then with a look back, you need to go and see which one of these moves actually has a 30% squiggle before you validate the high. And going back, it will be this high here. Now I'm going to push forward. So here are the new Q points. And you can see now, with the help of that localized Q point, you do get a retrace from a supply that's inside a Q point and created this consolidation, which is what? It's a phase 3, with a bearish engulfing, and then proceeded to move downwards from the localized Q point. So this, looking at this consolidation, this would be a valid way to execute a trade in cases where you have a newly formed swing. So it wouldn't be a flip zone. Now this new swing can be created anywhere, okay? New supply. It could be an entirely new location below the original demand, so it could be somewhere down here. But what I'm trying to get across here is that the flip zones generally don't work. This is a lot more likely scenario that you're going to come across, where the price completely ignores the broken area and goes on to test whatever is available much higher up. Now, I also will say that some people believe that supply and demand can be traded successfully from both sides. And I will say that if you do want to attempt that, which, you know, if you're still not profitable only trading one direction, I would probably not do that. But if you must, I will say that market profile would be a lot more likely to give you those trade setups to trade both sides. And I don't mean that you need to be like super rigid on the trend rules, because as you grow more and more, as you go through the course and you develop your skills further, you should start using market profile for your shorter time frame trading decisions once you've analyzed the supply and demand and Q points on larger time frames. So in this particular example, what do we know? We know that there's a previously bouncy reactive demand that was broken. So what does that tell you? It tells you that the supplies are in force on this particular time frame. It's a 4-hour time frame. So this little piece of information means that on a 4-hour chart that we're staring at right now, it's probably wiser to neglect the Q low areas and the demands and instead to focus on the Q highs and the supplies. Now, obviously, again, I'm simplifying the rules somewhat because there's an added component of doing multi-time frame analysis. So, for example, if the break of this demand brings you into a larger time frame swing extreme, obviously, this is a bit of a simplification, again, of the rules because there's an added component of multi-time frame analysis. So for example, we're only looking at a 4-hour chart here. So from this chart, I cannot tell whether by the break of this demand, we've actually arrived at a larger time frame demand. In which case, if you get a bounce and then you get a supply coming up on a lower time frame, obviously that's going to be a big problem, because the larger time frames will usually always win, and any reaction that comes from localized supplies will eventually be wiped out because the larger time frame is trying to go the other way. All right, it's time for the summary. So we were talking about, or I was talking about flip zones. They come from the old idea of support resistance that somehow got jumbled up with supply and demand. But if you are going to look at a concept of flip zones, the valid flip zones must always have a brand new supply and demand zone created somewhere either in place of the broken zone or lower or higher. Flip zones, you still shouldn't cut through candles. It breaks the first rule of supply and demand. Q points can then be used to further validate or invalidate your supposed flip zone. Q points can also show you whether it's a continuation of a trend or a newly established confirmed swing by using that squiggle rule that I talked about. And finally, if you take all of that into account, the newly formed supply and demand area in place of that perceived flip zone can then be traded just like any other supply demand area. So this concludes the lesson and my views of how you can trade flip zones if you absolutely must.